Hi everyone, I am Ruchi Shrestha. The agenda that we are going to cover in today's presentation includes executive summary, company O introduction, WACC calculations and evaluations, projected cash flow, NPV and payback period calculated WACC, NPV and payback period 18% WACC, investment appraisal techniques, funding options for the project, conclusion and recommendation, and appendices. Today we'll be discussing the financial feasibility of Summit Co. New high end travel package that is designed for high net worth clients to give a snapshot of what's coming up. And this project has a calculated weighted average cost of capital, which is also known as WACC, of 7.14%. So, the financial projections are promising with a net present value, which is called NPV, of 2.93 million under the weighted average cost of capital, and the payback period, which is attractive as well. This analysis does not just focus on the numbers, it's about helping summit trails make informed strategic decisions. So, over the next few slides, we'll dive into everything from the company background and financial calculations to funding options and final recommendations. So, let's get started. Let's take a closer look at Summit Trails Co. At its core, this is a luxury travel company that specializes in guided mountain expeditions and a personalized adventure travel in the Himalayas region. So it's just not about destination, it's about creating unforgettable, immense experiences. So our travel packages includes scenic helicopter tours where clients can enjoy breathtaking views and access remote locations effortlessly. We also provide elegant accommodations and high tailored services to meet the unique preferences of every traveler. As the slide mentions, our target audience consists of discerning clients who seek rare, extraordinary adventures. So these are people who value both thrill and sophistications. With such a well defined niche, Summit Trails is uniquely positioned to deliver unmatched luxury experiences. So, for WACC. Now let's talk about weighted average cost of capital, or which is also known as WACC, which is central to any investment decisions. So as the slide shows, WACC combines the cost of equity with which is 6.67%, and the cost of debt, which is 8.33%. So after adjusting for the respective weight, we arrive at a calculated weighted average cost of capital of 7.14%. So now let's break down how these components come together to calculate WACC. So Summit Trails Co has the total capital of 12.6 million, which is composed of 9 million in equity and which is 7. Um, for 3% and 3.6 million in debt, which is 28.57%. So to determine the weighted average weighted cost contribution of each, we multiply their respective cost by the proportion in the capital structure. So which means equity contribution is 6.67% into 1.43%, which equals to 4.76%. So debt contribution includes 8.33% into 28.57%, which equals to 2.38%. So by summing these contributions, we arrive at the final WACC of 7.14%. So this represents the minimal return of the company must generate to meet investor and lender expectations. So, why is WCC important? As the slide mentions, WCC serves as a benchmark for evaluating the viability of the project. So, if the project return exceeds this rate, it is considered to be a good investment. So, in this case, the project surpasses the benchmark, so which is a great sign. And WACC is also used as a discount rate for calculating NPV, ensuring we're factoring in the time value of money effectively. So, talking about the projected cash flow, um, As the slide shows, total income is expected to rise from £5 million in year 1 to 7.52 million by year 5, with a peak at 8.8 million in year 3, driven by strong market penetration and demand. On the cost side, we see an increase in year 3, reaching 6.32 million, primarily due to heightened operational and marketing expenses. However, what's reassuring is that costs begin to decline in the following years, reaching £3.96 million by year 5, which leads to improved profitability. Now, let's talk about some critical financial aspects that contribute to this cash flow. So, the sunk cost, the company already has spent £200,000, which cannot be recovered since it's an expense that has already occurred, and it does not impact future cash flow but is important for historical cost considerations. So, depreciation. Since the project involves investing in high value assets, depreciation plays a key role. The helicopter's initial cost is £5 million, and after considering a salvage value of £200,000, the annual depreciation is calculated by dividing difference over its 7-year useful life. This ensures that asset valuation is fairly distributed across the years. Working capital recovery at the end of year 5, the £1 million working capital is injected at the start of project for operational liquidity and will be fully reimbursed, boosting the final year's cash inflow. So, residual value, which is also known as salvage value, since the helicopter's total lifespan is 7 years, but this project considers only a 5-year period, the value for the remaining 2 years of useful life is retained as its salvage value. This represents the helicopter's remaining worth beyond this investment window. So, what's more important to note here is that despite variation in cost and revenue, net cash flow remains positive throughout the project's lifetime, reinforcing the financial sustainability of investment. So the key capital budgeting insights consist of 3 pointers, which is positive cash flow, cost management, and financial feasibility. So talking about positive cash flow, net cash flow demonstrates stable growth, accumulating in a peak of 3.56 million pounds by year 5. So for cost management, expenses escalate notably in year 3 but decrease in subsequent years, that is year 4 and 5, improving profitability. So, financial feasibility, the analysis indicates strong financial viability with consistent profitability and attractive returns. Now, going to talk about NPV and payback period for calculated WACC. So, starting with NPV, the project requires an initial investment of £6.05 million. By discounting future cash flows at this rate, the total present value of projected cash flow amounts to 8.98 million. So, after deducting the initial investment, we obtain an NPV of £2.93 million, demonstrating that the project is expected to generate substantial financial value. For the payback period, the investment is recovered sometime between the third year and fourth year. To pinpoint the exact duration, we calculate the daily return from the discounted cash flow of year 4, which comes out to £3,560 per day. Based on this, the remaining amount is recovered in approximately 249 days, resulting in discounted payback period of 3 years and 8 months. This relatively quick recovery further supports the project's financial feasibility. So, next we're going to talk about NPV and payback period for historic WACC. So, using the historic WACC of 18%, starting with NPV, the project requires an initial investment of £6.05 million. When we discount the projected cash flow at this higher WACC, the total present value of cash inflows comes out to £6.65 million. After deducting the initial investment, the resulting NPV is 606,000. While still positive, this is considerably low than £2.93 million NPV calculated using the current WACC of 7.14%, making the project less attractive under this scenario. For the payback period, the investment is paid back between the third and fourth years. To determine the exact timing, we divide the discounted cash flow by year 4, which is 8 lakh 83,223. So by 365 days, we divide it, which gives a daily return of £4,267. Using this figure, we calculate that the remaining investment is covered in approximately 223 days, leading to discounted payback period of 4 years and 7 months. Compared to the calculated WACC scenario, this longer payback period reflects the impact of using higher discount rate. So now talking about the investment appraisal methods, NPV, IRR, ARR, and payback period. So the net present value determines the net value a project adds by calculating the difference between the present value of cash inflows and outflows, adjusting using a discount rate. So the advantages includes that it reflects the time value of money, ensuring cash flows are approximately discounted, provides a clear indicator of a project's profitability, considers all cash flows, offering a thorough financial evaluation. The disadvantage is heavily reliant on the accuracy of discount rate used, may be difficult for non-financial stakeholders to interpret effectively. So the summary is that NPV serve as a reliable tool for evaluating profitability for Summit Trails Co's luxury package. So, however, its accuracy is contingent and on precise estimates of the cost of capital. So, internal rate of return identifies the discount rate at which the NPV of a project's cash inflows and outflows equals zero, representing the expected return on the investment. For Summit Rails Co's luxury package, this rate highlights its potential profitability. The advantages includes easy to interpret as a percentage, making it accessible to stakeholders using for comparing investments of different sizes or scales. So the disadvantages is can yield multiple values for projects with unconventional cash flow patterns, assumes reinvestment at the calculated IRR, which might not reflect real world scenarios. So the summary is that IRR is a valuable tool for evaluating the profitability of Summit Trails Co's luxury package. However, its effectiveness may be limited when dealing with irregular cash flows or exclusive investment opportunities. So, moreover, accounting rate of return (ARR) assesses an investment's profitability by comparing its average annual accounting profit to the initial investment cost. So the advantages includes easy to calculate and interpret, helpful for comparing projects of varying sizes, focuses on accounting profitability, making it simple to benchmark. So the disadvantages includes ignores cash flow and the time value of money, dependent on accounting methods which may differ, does not account for risk or other complex factors, and the critical evaluation includes that ARR is a useful tool for quick evaluation but overlooks important financial aspects like cash flow and risk. Is more effective when combined with other metrics such as NPV or IRR for a more thorough analysis. So discounted payback period is similar to the regular payback period, but it accounts for the time value of money by discounting future cash flows. So the advantages is that it provides a more accurate evaluation than the standard payback period, focuses on risk and liquidity while also considering profitability. So the disadvantages include does not account for cash value that occur after the payback period, more complex to calculate compared to the traditional method, and the critical evaluation is that while the discounted payback period offers greater accuracy than the basic method, it still does not fully address long-term profitability. It's more precise tool but should be used in conjunctions with other metrics for a comprehensive analysis. Now, talking about the funding options, equity, debt, internal and short-term loans. So, talking about funding options for equity financing involves raising capital by selling ownership stakes in a company with investors earning returns through dividends or capital gains. So, the advantages is that no repayment obligations, reducing financial strain, attracts investors who contribute valuable expertise and connections, ideal for high growth companies with limited cash flow. So, the disadvantages is that dilutes ownership and control. Returns to investors can be more expensive than debt interest, and stakeholders may push for higher returns, putting pressure on the management. So, the critical evaluation here is that equity financing is excellent for startups with strong growth potential but involves high capital cost and loss of control. So, while it aligns investors with the company's success, founders may weigh the benefit against the trade offs. So, the key consideration by equity investors is that financial information performance analyzes projected returns, the timeline for profitability, and the need for further capital injections. Market opportunities. It helps to access the company's potential for growth, its competitive landscape, and demand trends. Leadership strength, which includes to evaluation the leadership team's expertise, experience, and track record in driving success. So, for business stability, we investigate the long-term viability and scalability for business model. So, for risk factors, identify risk related to market shift, financial instability, and operational challenges, along with potential mitigation strategies. So, for strategic fit, we assess how well the investment aligns with the investor's broader portfolio goals and long term visions. So, now talking about funding options for debt financing. Debt financing involves borrowing funds through loans, bonds, or credit lines with the obligations to repay the principal amount along with the interest over time. So the advantages includes fully maintain ownership and control of the company. Interest payments are tax deductible, lowering the overall borrowing cost. Predictable repayment schedules help with financial planning. Disadvantages include fixed repayment obligations can strain cash flows, especially in challenging times. Excessive debt increases financial risk and may negatively impact credit ratings. High interest costs can become burdensome if the project don't perform as expected. So the critical evaluation includes debt financing is well suited for companies with suitable cash flows and manageable debt levels. However, excessive borrowing can lead to insolvency risk, and particularly during economic downturns. So the key consideration by debt finance is cash flow adequacy, assess whether the company can generate enough consistent cash flow to meet debt repayments, asset pledge, identify available assets that could secure the loan if necessary, financial stability, examine the company's financial health, including credit history, profitability, and overall balance sheet strength, loan term analysis, review the loan's interest rates, repayment structure, and the practical feasibility of the loan's condition, risk assessment to evaluate potential risk, including the likelihood of default and exposure to market volatility, with effective risk management strategies in place. Borrowing justifications confirm that the loan is being taken for legitimate, well defined business purpose aligned with the strategic goals. Now, talking about the funding option for short term loans, are a form of debt financing with repayment periods typically under 1 year, often used to address immediate working capital needs or cash flow gaps. So advantages include provides quick access to funds or urgent needs, more flexible repayment terms compared to long-term loans, and no dilution of ownership. So the disadvantages includes higher interest rates due to the shorter repayment period. Frequent renewals can lead to increased administrative cost and complexity. Tight repayment schedules may put pressure on cash flow. So, the critical evaluation for this is short term loans are effective for addressing immediate liquidity needs, but they are not suitable for long term investment. Over reliance on them can lead to the debt cycle if cash flow issues persist. So, the key consideration for short term loan providers is that liquidity assessment examines the company ability to generate sufficient cash flow to meet short term debt obligations. Asset liquidity ensures that there is asset available that could be easily converted to cash if necessary to secure the loan. Loan purpose confirms that the borrowed funds will address immediate financial needs such as inventory or working capital. Creditworthiness evaluate the borrower's credit history, financial reliability, and previous repayment behavior. So, repayment alignment ensure the short-term nature of the loan matches the company's cash flow patterns and repayment capabilities. Default risk assess the risk of default and determine the speed with which the loan can be recovered in the case of financial difficulty. So, talking about funding options for internal funding, which involves using the company's retained profits or reserves to finance new projects or operations without the need of existing financing. So, the advantages include no repayment or interest cost, making it cost-effective option. So, it maintains full ownership and control of the business, demonstrates financial stability and independence. So the disadvantages includes limited by the company's profitability and the size of its reserve, opportunities cost of using funds for not only using funds for dividends or other investments, relying too heavily on internal funds can limit growth opportunities. So the critical evaluation is that internal funding is a safe and cost-effective choice, but it may not be sufficient for larger projects. Companies must balance reinvestments with the needs for internals and for external financing and considers shareholder expectations. So the key considerations for internal funding cash flow availability ensure that sufficiency liquidity to support reinvestment without disrupting day-to-day operation investment. So the comparison includes evaluation the potential returns from utilizing internal fund versus exploring external investment options. Risk assessment consider the potential impact of financial setbacks on the company's retained earnings and internal resources. Strategic alignment ensure that the use of internal funds is in line with the company's long-term vision and strategic priorities. Control and flexibility retain flexibility and control over fund allocation, allowing for more adaptability funding decisions compared to external sources. Opportunity cost. Analyze the potential benefits missed by using internal resources for reinvestment rather than distributing in dividends or pursuing other investments. So, for conclusion and recommendations, to conclude, this project is not only financially viable but also strategically aligned with Trails Co's vision of delivering unparalleled luxury travel experiencing. Using the calculated WACC of 7.14%, the project shows a positive NPV of 2.93 million pounds and a discounted payback period of just 3 years and 8 months. As the slide highlights, the calculated WACC reflects current market conditions, making it more reliable benchmark than the historic WACC of 18%. Based on these findings, we strongly recommend moving forward with this investment. It has the potential to solidify Summit Trail's position in luxury travel market and generate substantial returns for stakeholders. So, talking about conclusions and recommendations, financial viability. This project demonstrates value creation with positive NPV under both WACC scenarios. The shorter payback periods associated with the calculated WACC reduce financial risk and align effectively with the company's investment strategy. Alignment with strategic goals. This project leverages the company's expertise in the luxury travel industry. Higher returns at a lower WACC underscore its strong market potential and reinforce its overall feasibility. Final recommendation. Following a thorough analysis of the financial and strategic dimensions of the project, proceeding with the investment is strongly recommended. So, for the appendices, we have detailed calculations and references. So, we have WACC calculations, we have calculations of projected net cash flow, we have projected cash flow for chart analysis and simple payback period. So we have discounted payback period for calculated current WACC, net present value for calculated current WACC, discounted payback period for historic WACC, net present value for historic WACC. So that's all for today. Thank you.